Hi traders, and welcome to the second episode of the questions and answers series. So the first question Sean sent in, and he actually did a follow-up to my last video where I briefly talked about how to become a disciplined trader. And his question basically is, hey Marco, isn't there more to do to become a disciplined trader than, as you said, to just do it and just be one? Isn't that too simplified thing to say about this rather complex topic? Now, of course, there's a lot more you can say about this. There's a couple of books out there by Mark Douglas, for example, that I can recommend where he talks about this in depth. So if you have any issues that prevent you from being disciplined, you of course have to deal with those. Now, there's also the other side out there where you have a whole industry that tells everyone, okay, to become a successful trader, all you have to do is sort out your psyche, sort out your mind and your attitude, and then you're going to become successful, saying that this is your edge and there's nothing else you need. And of course, nothing could be further from the truth. To be a disciplined trader means nothing else than you follow your plan, you follow your system, your strategy, your method, and you don't do anything you're not supposed to do. Once you have an edge in the markets, to become successful with it, you have to be totally disciplined and execute it. But without an edge, being disciplined won't help you anything. So you really need both. And there's a lot of things you can do. It really depends on the person, as I said. For me, a couple of things that really worked well. First of all, mindfulness meditation, which I do every morning actually. And this really helps me to settle down and get a clear view, get more focused, and makes it just easier to recognize when something starts going wrong. In other words, what this does is it increases your attention to a point that you're much more sensitive to what's going on with you. In other words, while before you might have just noticed that you're about to do something stupid while it's almost too late or it is too late, after some mindfulness meditation practice, you're gonna recognize these things much earlier when they're just about to happen. So you can start them right when you see, okay, something is starting to get wrong. I'm starting to get angry at the markets, or I'm starting to get less concentrated, less focused. You're gonna recognize it immediately or much more quickly than before, and then you can stop it much easier. Because once the whole train is running, when you're full of anger, for example, it's much harder to actually stop it and to stay disciplined. And another thing that's equally as important is to understand what trading really is and to understand the meaning of a single trade, to keep the perspective, to be able to detach from your trades, to detach from your P&L and see the whole picture. That is, what you're looking at is one trade or a couple of trades running, but it's just one trade or a few trades out of hundreds and thousands of trades you're gonna do. That's the perspective you need to have. And once you have that single trade is gonna be much less important to you than if you look at the trade and you watch it all the time and you have that attitude that this trade is gonna make it or not. It's not. Trading is a numbers game, and what a single trade is just a single trade out of a large series of trades. That doesn't really matter. Could be a winning trade, could be a losing trade. There's no way you can know. And to really understand that helps a lot to stay disciplined in the markets. And that's one of the things that Mark Douglas talks about in his books. And there's also a YouTube video out there you can find by searching for Mind Over Markets. Another book I can recommend highly is The Power of Habits by Charles Duhigg. And this book isn't about trading in specific, it's just about habits in general, how they develop, how to break them, and what power they have. And for me, this was really an eye-opener, so I can highly recommend you read that one. And for me, really at the end of the day, it does come down to just doing it. Because yeah, you're gonna read all that stuff, you have to think about it to some degree, you have to understand what trading is, you have to understand that trading is a numbers game. You have to understand your psyche to some degree. You have to be aware what's going on with yourself. But then at the end, it really comes down to execution. It really comes down to being a disciplined trader, living that and doing so again and again. And each time you do it, it's going to be a little bit easier. The next question I got is from Eugene about systematic trading. And he's asking, when it comes to systematic trading, is it necessary to know when a system is no longer working? Do they have a limited life? And if so, how can this be determined? In other words, when should you stop trading a system? And the answer to that is yes, trading systems have a limited lifetime, and that is due to the markets changing all the time. So not every little change is going to break a system, of course. One example I can give here is the US Swiss franc. And I had a very good system for that market back in 2010, 2011. I made some nice money there until the Swiss National Bank decided to peg the euro to the Swiss franc at a fixed rate. So they decided, okay, 120 is going to be it. And at that point, the market basically stopped moving. As you can see below, where you see the daily range of each price bar. Before that event, the euro Swiss franc moved regularly about 100 or 200 pips a day easily. And after that decision, euro Swiss franc barely moved anymore. It went down to literally 10 ticks a day, 10, 20 ticks. And considering the spread, at the same time, the volume dried up, there was hardly any liquidity anymore, the market barely moved, meaning you got wider spreads and less volatility, which of course killed my trading method in that market completely. So it was destroyed from one day to the next. And this can happen to any trading method in any market, because any market can change. You never know what's going to happen. Another example is markets just disappearing, like various futures contracts that you could trade in the past. You just can't trade anymore because they're gone. Other things that can destroy your trading method's performance are things like the trading times are getting changed. So before you might have had a method that traded the opening range in a specific market, and it was only open for a couple of hours each day, and now it's a 24 hours market. There isn't really an opening range anymore, and your method stops working. So in other words, you always have to be aware of these things, and when there are dramatic changes in the market, you have to reevaluate your system, see if it can still work, and then decide whether to stop trading it or not. Now, if we know that each trading system has a limited lifetime, how do we know when to stop trading it? And this really is a very difficult question to answer, that you always struggle with to some extent, and your view is going to change a lot on this. And I can't say much more than it really depends a lot on the method you're trading. So there's a big difference between trading a long-term trend following system and an intraday trading method that trades on 10-minute bars, for example. Obviously, the trend following system is going to be much more robust by its nature. It's going to have much longer drawdowns than compared to a day trading system that trades on a 10-minute chart, for example, and gets in and out of markets a lot. It's going to be much less robust, especially if it's just trading in one single market. So how can we approach this at all? The first thing you want to do is really have a look at the past drawdowns you have in a specific system. Have a look at the average drawdowns. So you don't just want to look at the maximum drawdown, but instead have a look at the average yearly drawdown and the 5 biggest drawdowns and so on, to get an idea of what to expect. And usually you have to expect that your maximum drawdown of a system is going to be somewhere in the future. So I tend to give a system at least 1.5 times the maximum drawdown of the past to recover before I stop trading it. It also depends on how often drawdowns occur, for example. So if you have a system where it's normal that you have 1 or 2 bigger drawdowns each year, and now it starts to have drawdowns a lot more frequently, that's another sign that you might want to consider stop trading the system. Another thing to look for is the trade distribution, that depending on the system, it's going to be pretty much the same, not just overall, but also in between. So you're going to have a tail in the middle where most of the trades are going to occur, and some on the left and right of this scale. Did anything change here? Did your average trade size decrease a lot? Or did, for example, the win-loss ratio change significantly? For a lot of systems, this is going to do pretty well, and that's to run a Monte Carlo simulation. Let's say I'm getting suspicious on a system during the last 100 days. I might want to check out if what's going on is normal, considering my backtesting results I had from the past. So I'm going to run this test and say, okay, I want 100 sample days and I want, let's say, 10,000 samples. And running that Monte Carlo simulation, the results you're going to get can tell you a lot about what to expect or what not to expect. In other words, what is still normal just due to noise, due to different distribution of trades you got, and what doesn't fit anymore. Another point I want to mention here is that if you just trade one system, you're going to look at it a lot more and probably turn it off much faster than if you're trading, let's say, 5 systems or even 10 systems, for example. Now imagine you trade 50 systems and one of these systems is in a larger drawdown than normally. This is going to vary you much less than if that one is your only trading system. It's the same as with having trades going on. If you only have one trade going on all the time, you're going to be worried a lot about that trade. But if you're trading a couple of markets, on average you have, let's say, 5 to 6 trades going on, that single trade is not going to interest you that much, which is one of the reasons why diversification is so important. Alright, so that's it for episode 2. So if you have questions you want to have answered in the next episode of this, just send me an email, comment on YouTube, or post it on our blog or forum. You might also want to subscribe to our YouTube channel, which you can do at youtube.com/tradingeducators, or if you're on YouTube already, down here by clicking on the subscribe button. This way you won't miss any of our videos. Also, if you haven't done so, check out tradingeducators.com, where you can find a trading blog, trading forum, various ebooks, articles, and you can sign up for ChartScan for free, which is our weekly educational newsletter. So thanks for watching this and see you next time.